I will note, at least on a short-term basis, I do think these trades are getting a little bit stretched. And with commodities, momentum often begets momentum. So you don't want to try to call a top. But when we looked at silver just last week, and the run that we've seen on a 6-month basis is the most we've seen since the Hunt brothers in 79 and 80. And when we see in about 5 other circumstances when it's kind of this stretch, and sometimes it does continue to move forward, the next few months.
That right there is the mood shift that a lot of investors miss when a hot trade starts feeling crowded. It is not a dramatic sell everything moment. It is more like a veteran trader noticing the room is getting loud, the prices are getting jumpy, and the easy part of the move may already be behind you. If precious metals have been the comfort blanket, the bigger question becomes what you rotate into when comfort starts getting expensive. And that is where today's story turns from metals to the next pocket of opportunity that could be setting up right now.
We were betting a bit of mean reversion taking place in 2026. One of the things we identified in our 2026 outlook in early December was that energy and materials underperformed over the last 5 years at a level that in the last 50 years have marked turning points higher. So we were betting that so much of the bad news was baked in that they could have okay fundamental years, but the stocks could do really well.
When people hear rotate, they often think it means chasing whatever is already screaming higher. But what Tom is describing is almost the opposite. He is talking about areas that spent years being ignored, sectors that started the year with low expectations, and plenty of skepticism priced in. That matters because a rotation works best when the crowd is late, not early. If metals are feeling stretched, the now what trade often lives in the boring corner that suddenly is not so boring anymore.
Yeah, one of the things we talked about a lot about last year was that when small caps turn, it tends to be a multi-year. In fact, it could be up to a 12-year period. So the last turning point for small caps, and on a relative price to sales last year or price to book, they were at the exact same point they were in 2001. That was a launch point for 12 years of relative outperformance.
This is where the rotate into this stock now idea starts to make more sense, even if you are not literally thinking about a single ticker. When small caps wake up, it is often expressed through a familiar proxy like the Russell 2000 and vehicles tied to it. And the logic is that the move can last longer than most people expect. In other words, it is not always a one-week trade. It can be a change in leadership. If you have been hiding in the safety trade, small caps can feel like the opposite of safety, but that is also why the upside can surprise people.
So in 2026, I think there's a good fundamental earnings story, earnings growth accelerating. But we have 2 transitions to deal with. One is the Fed, a new Fed. The market always tests a new Fed. So from confirmation, let's say that starts in March, a new Fed happens, and then the market tests him. That's one source of a drawdown.
Here is the catch, though. Rotations do not happen in a calm, perfectly choreographed market. They happen while the headlines are messy and investors are second-guessing every dip. Tom's point is that you can have a healthy earnings backdrop and still get smacked by uncertainty, especially when the market starts testing whoever is calling the shots at the Fed. That kind of environment can shake loose leadership because money starts searching for the places it thinks can handle turbulence better.
The second is, of course, policy. The White House is much more deliberate this year in picking winners and losers, and there's some uncertainty around the tariffs. Last year, that was enough to drive a 20% decline in the S&P. So I think the combination of policy uncertainty along with Fed could create a drawdown that feels like a bear market, but that's from higher levels as well.
That is the emotional part of the story, because nobody enjoys living through something that feels like a bear market, even if it is happening from higher levels, and even if the longer-term thesis stays intact. And notice what that does to investor behavior. When policy uncertainty rises, people run toward the obvious safety trades, and right now metals have been wearing that crown. But if metals are stretched, the rotation trade is about preparing for what comes after the panic bid, not just admiring it.
Well, I think it's a prelude to what a bigger drawdown looks like, because just a social media post about Denmark caused a 2% decline in the S&P and a spike in the VIX. And that was, of course, quickly diffused. But imagine a scenario where there's a series of policy headlines that markets get anxious about. It could easily lead to a larger drawdown.
This is the kind of detail that makes people rethink what they own. If a single headline can slap the market around, the next few months can turn into a constant stress test. In that world, the rotate now argument is not about being fearless. It is about being positioned before the crowd realizes the leadership is changing, and a rotation often shows up as money moving away from the same mega cap names everyone has leaned on and toward areas that benefit from a broadening market.
Any of the four Mag 7 companies that we're scheduled to hear from, Microsoft, Apple, Tesla, and I'm blanking on the fourth one, sorry, but that's 15% of the S&P 500's Apple. Thank you. I don't know how I could forget them. But that's 15% of the S&P 500's weighting, and that is very important because it's going to determine whether the rotation away from tech continues, or if we hear guidance from those four companies that backs up what we heard from TSMC a little bit ago, that basically bookings are sold out through the entire year, and the money that these companies have been spending is not going to slow down anytime soon.
That right there is the fork in the road. If tech leadership reasserts itself, the market can snap right back into the same old habits. If not, the rotation gets oxygen. And when rotation gets oxygen, you usually see it in the places people ignored while they were hypnotized by the biggest names. That is why small caps, energy, and materials keep coming up. They are not a random side bet. They are the market broadening trade, the one that can work even when investors are tired of paying premium prices for the same crowded stories.
I think that we go from 5,000 and then we start talking about when do we see 6,000, because the angst in the markets that we're talking about, it's not going away. And it's also not going into the 10-year treasury the way we historically would expect it to do, with yields continuing to rise. And so I think that gold more than likely continues to be the safety trade globally for investors who are either selling away from America or U.S. investors who are also thinking maybe I ought to be looking somewhere outside of the S&P 500.
When people feel uneasy, they want something that feels like it sits outside the chaos. Gold has that reputation, and when it starts moving, the story writes itself. But the key tension for today's project is right here. You can acknowledge the safety appeal, while also noticing when the trade looks crowded and the risk-reward starts shifting. That is when you start looking for the rotation that can work if the fear cools off, or if the fear simply changes shape.
I think crypto has been suffering from deleveraging. You know, in October 10th, there was that one-time price shock that was the biggest deleveraging of crypto in history. And then this week, crypto was doing well until the Greenland announcement, which triggered the move in JGB yields and a deleveraging in crypto. So I think crypto, unfortunately, is sort of would track gold, but you have to subtract deleveraging, and I think that's really what's been hurting crypto.
Tom bringing crypto into the metals conversation is useful because it highlights something bigger than any one asset. A lot of these alternative trades get pulled around by liquidity and leverage, not just by narratives. That same push and pull can spill into equities too, especially when investors are rotating in response to volatility. So if metals feel topped or stretched, the question becomes where liquidity wants to go next in stocks, not just which asset sounds safest at a dinner party. Today's story was really about timing and crowding. We heard a clear warning that commodities can get stretched, even when the long-term narrative still sounds convincing. We also heard the argument for rotation, not as a random gamble, but as a shift toward areas that have been ignored, like small caps, energy, and materials. And we saw how volatility, policy headlines, and shifting expectations can force investors to rethink what leadership looks like when the market broadens. Before you decide what you would rotate into right now, listen to this last piece, because it hints at how the next market infrastructure story could steer where money flows.
Larry Fink talked about everything being tokenized onto a common blockchain. David Sachs talks about how once the Clarity Act's passed, digital assets and basically the architecture of Wall Street are going to merge. I think crypto is still really relevant as a settlement layer, but it is more a story of smart blockchains, which is more of an Ethereum story over Bitcoin. And as you know, Bitcoin maybe is getting dinged because there's some concerns about quantum being able to steal or capture a third of the Bitcoin legacy wallets.
After hearing all of that, do you think the smarter rotation from stretched metals is towards small caps and underloved sectors? Or do you think the real rotate now trade is still hiding in the next wave of tech and digital infrastructure?